So guys, very happy Sunday morning. Year Kai Tune as we always start. And my name is Desika Prabhakar, the founder and director of the Purpose Foundation. And we have our darling Lakshmi here, a COO of our the Purpose Foundation, where all your purpose is going to come to life, to reality. And today we have some excellent sessions planned for finance and budgeting of all your ideas, prototypes, and your future startups. So we will have a lovely introduction from Lakshmi on our speaker today.
A very good morning to everyone. Thank you all for joining us for today's session on the topic that's crucial for anyone who's navigating the business world, that is finance and budgeting. So we have an exceptional speaker today with us whose insights are sure to enlighten and inspire all of us. Mr. Prashanth KL, a seasoned chartered accountant with over 22 years of experience in the realms of finance and taxation. Currently, he's a partner at Guru and Jana. Sir has been an instrumental in shaping the firm's approach in both the indirect and direct taxation, with his expertise spanning across domestic and international tax matters. His career is marked by his leadership roles at prestigious organizations like the UB Group and the Arvind Group, where he has headed finance and taxation and led the critical monitoring teams. Beyond his corporate achievements, Sir is deeply committed to his education and knowledge sharing. As the lead of as the head of training at Guru and Jana, he has influenced countless professionals, and his contribution extend to the academic world through co-authorship of books like on the related topics like international taxation and GST. His knowledge has been sought after on predominant platforms like ICAI, DTRTI, and various international conferences from Dubai to Delhi. In addition to his professional accomplishment, Sir holds a Bachelor of Commerce from Bangalore University, a diploma in Information Systems Audit, a certification in International Taxation from ICAI, and a law degree from Hubli University. His dedication to fostering a culture of learning within the organization serves to be truly commendable. We are fortunate to have someone of his caliber with us today. So, without further ado, I'm very happy to welcome you all to this session.
Thank you so much, Lakshmi. So, Mr. Prashanth, if you are here, if you can hear us, you can please take over.
Yes, certainly. Happy morning. Happy morning,
Thank you
everyone.
so much for joining us today. Thank you so much. We really appreciate it. We're very happy to have you here.
Thanks a lot, Desika. Thanks a lot, Ovi Lakshmi. That was a very generous introduction, I have to say. So, today, I mean, you have chosen an interesting topic. Though it is a Sunday, you want to learn more about business. That is the happy thing. So, and more so, it is a topic that touches upon the startups, which has been one of the important main practice areas, in fact, we as a firm engage in. So if you see some of the main startups that are there in Bangalore today, probably they would have started their incubation right at our office, in fact. So that is where startups are quite close to us. Having worked with startups, I think it is, privilege probably to talk about it. So just to start, let us say, imagine you're the founder of a tech startup. You're starting a technology startup. You're brimming with ideas, lot of energy. You want to do something. You have developed a product. You attracted some attention. People are there to see your product, and even secured initial funding also, assume. But suddenly you are faced with a stark reality, that is, cash is running out much faster than expected. So why is that? You are in the business, so the business runs only if you put cash. So if there is no cash, the business cannot run. So it is something like you have to put the cash, then only you'll be able to reap the profits later. So if cash is running out, then the business is gone. So you are burning through resources, hiring high cost talent, spending on marketing without understanding what is the financial landscape that is ahead of you. This is the unfortunate story of many startups that could have been prevented with a better grasp of financial management as such. So that is why it is important to understand financials and budgeting. It is very critical to the startups as such. It is to ensure efficient resource allocation. You have several resources in the business, you have to allocate it properly. For example, a tech startup projecting, say, some 10 lakhs or 1 crore annual revenue, something like that. should budgets for, because it is a technology company, it should budget for how much does it cost for, say, software development, marketing the software, doing the operations of the business, what is the cost? These things can be done by creating a cash flow forecast and prioritizing expenses for sustainable growth as such. So when you look at these startups, what is it that you can see? All of you must be glee and you must be happy because in one or the other way, you must be either using them or playing with it, or as it is quite interested about, learning more about these things, because these are the people who made it big in their lives. And some of them went on to become the unicorns of the country. As we discussed today, totally we have over 114 unicorns in India. So each of them are over 1,000 crores of market capitalization. That is the value of these companies. And they have really worked very hard to ensure that it has to reach this kind of a stage as such. So these leading digital giants, if I have to say, it can be Cred, Zomato, Swiggy, Razorpay, Flipkart, Dream11, Paytm, Ola. They have revolutionized industries across India, in fact. So they are from, say, food delivery to online payments, e-commerce. Some of them looked at urban mobility. How do we move from one place to another? They represent innovation, convenience, and growth. And they have transformed millions of people's life, work, and they in fact engage with the digital economy very, very uniquely, I have to say. But however, it is not only good stories and all rosy pictures all the way, because all of us know, and probably you have to know also if you have not heard, it is something like if there are some 100 startups, the chances that only 2 or 3 may survive or 5 may survive. Many will go off. So these were, several startups as such, which went on, having brilliant ideas, but unfortunately they could not do well. You can see them. Right on the top, Paper Tap is there. It is something they thought that it will do very well. Millions and millions of dollars were funded into it, and unfortunately, looks like they were early to the market, and unfortunately, they could not make it. But there can be any reason. For example, for a startup to fail, there can be several reasons. Whatever may be the reason, finally, what matters is cash. If that cash is not taken care, then it is gone. In fact, you have to see these companies here. These are, collection of those once thriving startups, in fact, that have now shut down or struggled significantly. It, in fact, highlights the harsh realities of entrepreneurship, where innovation alone it's not enough. It is important to think about execution, market adaptability, sustenance. In fact, how do I sustain the business in the long run? No, in fact, each of these logos represents dreams that faced immense challenges. Their journey reminds us that even the most promising ideas can falter without strong business models, efficient operating systems, and moreover, there has to be resilience to changing market dynamics. The market dynamics are most unpredictable. You think that you have a brilliant idea, you start something, some legal provision comes and tells this kind of a business is not allowed in the country. But the entire thing is gone for a toss. So that is how tricky it is. So this is where it is important to right at the beginning stage of the budding, startup entrepreneurs, promoters have to start thinking about financial management. That is why it is necessary that financial management has to be taken care. So in the financial management as such, see, there can be several jargons, there can be several concepts, there can be several, I should say, formulas. It can be anything, you'll deal with tons and tons of issues or tons and tons of what I should say, the permutations, combinations, everything in this. But finally, what matters is cash management. That's all. So understanding cash flow is critical for startups, and failure to manage it effectively often leads to failure. So this is the one important thing that we have to have in mind. But then, what is it that we have to manage? At least at a top level, let us try to understand what are we trying to manage in finances. Very simple items that we have to see. Bank balance. You are supposed to monitor cash reserves regularly to ensure liquidity. You are running a business, you need to have an eye on the bank account, thinking that, okay, so much money I still have. Okay, so I have something to back up. Let me go ahead in the business. Of course, you should have an eye on revenue inflows and revenue outflows. You have to track income and expenses carefully to calculate burn rate and runway. So it should be, I have to emphasize here that knowing three key numbers here, that is bank balance, the money coming in and the money going out, it is essential for every founder. These basic figures allow you to calculate important metrics like burn rate, runway, and growth rate. What are these? While the numbers may seem straightforward, many founders overlook them. Without tracking these, startups and quickly find themselves in financial trouble, in fact. You don't need fancy software or accountants to monitor these metrics, just access to your bank statements and a commitment to review them regularly. You have to keep reviewing them regularly. This simple practice can help startups stay financially healthy and avoid unexpected cash shortfalls. So, just to take away the noise that you may have in your mind as to what is this concept that I'm talking about, let me give a few inputs to you on this. Burn rate. See, all these terms that I'm introducing you to is for preparing you to the startup space. Tomorrow, you are a promoter of a company, an investor comes and he's sitting on the negotiate table and he tells, okay, what is your burn rate? It should not feel like, what is that? So, of course, it is nothing wrong to ask the investor, you please tell me what is burn rate. Let me figure out that. I understand. But then it is good to be prepared before we face any such things. And that is the reason I've just put across few basic things here. Burn rate is a critical figure that represents the net cash outflow. Okay, what is burn is what? Burning. So it is going out. And it's calculated by subtracting your revenue from your expenses. Interesting. Revenue from expenses. So startup has an assumption telling that always your expense is more than the income, right? So that is the burn. Runway tells you how many months you have left before the cash runs out. And it is calculated by dividing the current bank balance by the burn rate. So that is, you'll see what is the cash balance divided by burn rate. What is burn rate per month? How much I am spending. So it will show how many more months my bank balance can last. So that is the runway. So it should also be stressed here that startups must be honest with themselves about these numbers. Sometimes to make them feel better, if they put burn rate as low, then it will look like, the number of months the cash would be available would be for a higher time period. It is not that easy. We have to be truthful to ourselves. So it is essential to calculate burn and runway based on real numbers to plan effectively and avoid running out of cash unexpectedly as such. So these are some of the things that we have to always keep in mind. So next, what we do is, because we understand now why cash is important, how much of cash I should have, what is burn rate, how I have to, keep having my eye on what is my cash balance. Okay, now that as a businessman, you're thinking from this perspective, it is also important that either your product or your service that you're trying to sell, right? For it to be having a proper response. Demand for product may be there, but the proper response would come. And one of the key ingredients to ensure there is proper response is to ensure there should be pricing of a product. So how do we price a product as such. So pricing a product involves evaluating costs. Very important. Then understanding the target market. Which market are you going to cater to? And analyzing competitors. So it is essential to balance profitability, that is for yourself, customer value. To the customer, what value are you giving? Both we have to balance. Ensuring the price covers production expenses and aligns with perceived value. So it is both ways. Consider pricing strategies like, on my cost, how much margin I have to add. What is the value base of my product or service? And most importantly, very importantly also, you should keep in mind competitor-based pricing to optimize both revenue and market position. You have to optimize both. So that is why it is important to have an eye on how the competitor is pricing as well. So as a first step, as we discussed, let us calculate what are our costs as such. So we have just taken certain examples. Primarily for your running of the business, you will have raw materials, labor, packaging costs. This is for a product. Similarly, for a service, packaging may not be there. That is the reason for example 2, mobile app, I have taken software development and testing only. I have not taken packaging. Normally packaging is like, for a product, you need a package. App is like, how you're making to, going to make the user interface nice in the mobile app as such, and nothing to do with packaging much there. So I've just taken 3 examples here, and let us see in the next 3-4 slides how this cost and profits span out. So for example, say creating handmade jewelry, it involves 150 rupees in materials, 400 rupees in labor because you have to make it beautiful, and 50 in packaging. So total is 600 rupees. In a tech development, such as creating a mobile app, cost might add up to 1 lakh. Okay. For development and testing, even for tech gadgets, identifying part costs, say 1,500, assembly 500, packaging 200, ensures your total production cost is around 2,200. So with this, first thing that you have sailed through is you have understood what are your costs as such. We have crossed step 1. Now let us see, what do we do next? We have to start planning what should be our margin. So much is the cost that I have. Let me add some margin, because why am I doing business if I am not making the profit at all? So let me add some profit. Mind you, these are still direct costs. On direct cost, I'm just adding margin. We'll come to later other expenses that are there in the business. We'll come to that. Okay, add a margin to ensure profit. Say around 20 to 50% is what I'm assuming here. Handmade jewelry, I'm looking at say 50% margin. So 600 is the cost, 300 is profit, 600 plus 300 is 900 is the selling price. Mobile app, 1 lakh is the cost, 30% is the margin. So 30,000 plus 1 lakh, 1,30,000. Tech gadget, 2,200. So 550 is the margin, 2,250 plus 550, 2,750 is the selling price. So we have come to a selling price. So is this the end of it? Let us see. Now there will be few things that gets added and it will start making interesting in our business. Now, compare prices of similar products. For this, you have to do research in the market. Researching the market is crucial to understanding the competitive landscape. By comparing similar products, you can ensure that your pricing is competitive and attractive. For example, if handmade jewelry in the market ranges from 800 to 1,200, you are setting your price at say 900 rupees. It can be both competitive and profitable, correct? I'm just looking at a range where we can place the price. So similarly, if say mobile apps are priced between say 100 and 150, setting yours at 130 ensures competitiveness. So here, see, pricing of the mobile app on the cost, it is not that easy to do it, because when it comes to mobile app, you're not selling the mobile app as it is. In case the entire mobile app I'm selling, then I understand some 1,30,000 I'll put. But when I own mobile app and I will allow you to use it, then I don't take the entire 1,30,000 from you. You are a user, I'll tell, okay, per month pay me 100 rupees, per month pay me 150, something like that. In the case of a tech gadget, what happens if competitive prices, say it is ranging between 2,500 to 3,000, a price of say 2,750 positions your product. You understood where I am coming from? We have a cost, we have added our expected profit, then we found, okay, so much if I earn, I'll be happy. But that is required. We need to understand where we would like to go. But then step 3 is where is the reality check. You're going to the market and checking what is competitors' pricing, then giving it a range within which you're going to give the pricing of your product. Next, generally going into the market is one thing. Understanding your customer is deeper. Always, as a startup, promoter, entrepreneur, most important thing you have to see is, how will my customer get delighted? Unless you focus on delighting the customer, he is not happy to come to you, right? You can see any of product or the service that you are seeing. There is a specific way in which, say, Domino's packages a pizza, and compared to any other restaurant which is making a pizza and it is, packaging it. It's something like, look at the kind of mind that we have. We'll see, okay, only if it comes in the package of Domino's, it's almost like, I'm eating pizza, or otherwise it is some other dish, that kind of a feeling, right? And more so, we should also see from the pricing perspective how this is panning out, correct? So that is why we need to understand the psychology of the customer from pricing perspective also. So understanding your target customer is essential to adjust the pricing strategy, what we discussed now. For instance, if you sell handmade jewelry to college students, pricing at say 800 rupees, it may make it more affordable and appealing to them. For a mobile app aimed at institutions, some larger institutions you're selling, offering bulk pricing, such as 100 per license for 50 plus purchases, something like that. For example, you're going and selling to, we are a CA firm, we are a chartered accounting firm. So I'll go and sell a database of say some transfer pricing or income tax case law something, and I go and price it to a individual practicing chartered accountant. And I'll put some price. I'll tell, say, this much it is. But I'll come to, say, a firm like ours where we are totally around 705 people now. Now I know these people need more license. Let me reduce the price per person and get a larger share revenue out of it. In the same way, if your tech gadget targets professionals adding, say, premium features, you are adding some premium features, justify, say, higher price possible of 3,000. So because you are meeting their expectations, especially for quality and functionality, while still maintaining enough of your profitability as such. So this is one more aspect that we have to consider in the pricing as such. Next factor we have to consider is, what we have to consider in pricing is also the future growth that we are supposed to see. When setting prices, consider future growth and scaling costs to ensure long-term profitability. Because there is possibility that as and when you grow, there will be some cost that will be scaling up also. In that case, what do we do? For example, if you plan to hire help for your handmade jewelry business, you were doing all along yourself, only 3 people were there. Now you are adding 2 more, or you are adding a specialist, thinking that, okay, my time is going in, lot in checking the QC. Let me get a QC in. Okay. So if the QC has come, then what do? I have to pay additional 10,000 rupees. For example, it may be 1 lakh also, but example, say 10,000, I have to pay more. Then what I would do, I would just adjust the price. Okay. Similarly, if a mobile app incurs extra server cost, my mobile app I've introduced, people have started using it. As and when they use, the data has become larger. If data has become larger, I need server space. If I need server space, I have to buy 1 more server. So instead of, say, in example, 20,000 per day, 20 lakhs. You understand the kind of complexity that we are in. Of course, server is available for 1 lakh also. You might increase the price to, say, 135 rupees. For tech gadgets covering marketing costs of, say, 50,000, tech gadget requires, okay, some additional marketing cost has to happen. Then, while keeping the price at 2,750, it can help you absorb growth expenses without alienating the customers. You don't want to leave the customers out, but yet you're able to retain them with a little bit adjustment of the prices as such. So we can see here, as in when we keep going ahead, we are seeing how the pricing logic spans out, and it goes into different dimensions and aspects of what all needs to go in our mind in order to take a decision on the pricing of a product or a service for a customer as such, right? Now, we have seen a little bit more in detail of the pricing of product. Let us see, if you get a lump sum of money as a startup, how we are going to break down them into different portion of expenditure. Let us take this breakdown of startup expenses as such. What are these? So I have the expense category, percentage of the total money that I have, and how much money out of the total I have allocated as such. Okay. So what I've done, I've taken for research and development around 40,000, marketing and customer acquisition some 60,000, production cost, it says 1 lakh, but again, you can just, I've taken example of a increase in production, and that is why there is more cost and all that. But say based on the lesser production, the number may change. Instead of 1 lakh, say it is 20,000. Miscellaneous contingency, 10%, say not 20, say it is 10,000. Just for our example, we'll change the numbers a bit. Allocating your startup expenses strategically is vital for financial success. Typically, 40% of the budget is allocated to R&D. Can you tell me why? So it is to ensure product innovation and refinement. So you have a brilliant idea, and later you come across and see that there requires some sort of a minute adjustment, little bit adjustments in the product. So unless you invest in product innovation and refining the product, you'll not be able to see a new version of your product as such. That is why in the initial stages, the startup expenses will be high on research and development as such. Then marketing and customer acquisition should account for 30%, helping to attract and retain the customers as such. Production cost, it includes manufacturing, packaging, and shipping, right? Finally, you have to set aside some 10% for contingency. What kind of contingencies may come? Few may be unexpected. For example, out of nowhere, somebody may come and claim, telling that, no, this is my product. As a result of that, you have taken my IP. That becomes very difficult to handle. So if there is a legal fee, how do I get the money for that? So some 10% contingency is there. My machinery is running, it is producing the product immediately. It has become, it is causing some trouble. So I need to repair it. Or I have to emergently do some stock replacements in my products. So this is to ensure business remains financial stable asset. So that is the reason I'm supposed to have this contingency in my cash flow as such. So this is one more aspect that you have to have in mind. Now, if we break down a little bit more into each of these aspects, we can quickly just see what it is. So it is like investing in R&D is crucial for quality and innovating. Allocating 40%, it helps to cover product development and testing. For instance, a tech startup with say 1 lakh budget might spend 40,000 on software and testing. A fashion brand with 5 lakhs budget could allocate 2 lakhs for fabric sourcing and samples, because those sourcing and samples is where they do a lot of designing and check, okay, these I'll put on the models and find out whether this fashion can work outside or not right now. Similarly, a food startup, if you see, it can have a budget of say 2 lakhs, 80,000 on perfecting say recipe. You have to perfect the recipe, right? And packaging design, ensure product readiness for the market. In fact, one of the startups that can immediately come to my mind, there is a startup which is dealing with health of the people as such. And they, what they do is they use food as medicine. For example, in regular food that we have, 75 to 85% of our food is carbs. So in the food that they prepare, the carb percentage is between 15 to 20%, and rest of it is proteins, vitamins, etc. So in those cases, they have to come up with very unique recipes. Otherwise, they cannot sell the product, their food as such. Now, when I spoke to their promoter as such, he told me, see, we have put a lot of effort for this. And in fact, right now, only from perspective of the health, we have totally 2,600 recipes where they don't use either rice or wheat or rava, maida, millet, nothing they use, but yet they have 2,500 recipes as such. So that is the kind of deeper research that is involved in the case of the product that you're dealing with. Coming to your marketing and customer acquisition, it is key to building brand awareness. People should start recognizing your name right at the early stage. Allocating, say, 30% of your budget towards marketing ensures, adequate coverage, because it requires advertisements, promotions, some strategic partnerships that you have to do with, say, something like a media or some PR professionals, etc. So some cost will go in that as well. But all these things will look very fancy, but we should not keep on spending the way, just like that. It should be based on budget as such. For example, an app launch with a 1 lakh budget might allocate, say, 30,000 to social media ads. So 30% they're keeping there. A bakery with some 2 lakh budget could spend 60,000 on, say, flyers and doing some events as such. An online store is there with a larger, say, 10 lakhs budget. It may invest 3 lakhs in influencer marketing to reach a broader audience. And, they have to increase the conversions. That is the reason they have to do this as such. Next comes the production cost. So here, production cost encompass, as we discussed, say, manufacturing, packaging, shipping, and it generally accounts for around 20% of your budget. For instance, handmade crafts business with a 1 lakh budget might allocate 20,000 for materials and packaging. A tech gadget startup around 5 lakh budget could spend 1 lakh on assembly and shipping. So it is quite possible that the production costs based on the efficiency may change. So we have to be quite mindful of, in the production or the process, how we can keep modernizing or improving the efficiency so that the product costs come down as such. Anything that we can do to reduce the cost always tends to increase the profitability. Simple logic. Then comes the contingency fund. Setting aside at least some 10% of your budget for contingency fund is very vital. It has to cover some unexpected expenses as such. That is why it is important. As I told, assume you need some additional server and you need the server fee. From where will you get it? You think that, okay, you are in food delivery business, you have a food truck, and something happens to the vehicle. Immediately some 50,000 rupees vehicle repairs would come. So from where do we get the cash? So we should have contingency. So this is how I should say, to just recap, on an overall basis, how do we do the budgeting as such? Budget is a very minute exercise. For the kind of the focus that we have for today's presentation, I've just put it at a very overall perspective so that you understand the basics of the entire budgeting as such. So that is the reason I have given like this. So once you are aware of this, it is very important to introduce you to financial statements as such. As an entrepreneur, as a startup, right? Tomorrow, if you start your business, what are the financial statements that you're going to deal with as such? So basically, there will be 3 key financial statements. So this has income statement, balance sheet, and statement of cash flows. These documents together, it reveals company's profitability, financial stability, and liquidity as such. This is the purpose of this statement. Now, the income statement focuses on profitability, showing difference between revenue and expense. Very simple to understand. The balance sheet provides a snapshot of business's financial standing, right? It has to balance assets, liabilities, and capital. That is the owner's equity as such. That is what is represented in the balance sheet. Now you understand what is income statement, what is balance sheet. Income as revenue and expenses, balance sheet has asset, liability, and capital. So this we have to keep balancing in the accounting concept as such. So that is what we need to understand. Then it is also important to have something called as a cash flow statement. So what is the cash flow statements? We need to understand from where the cash is coming to where the cash is going. And broadly, over a period of time, people have come across certain three types of cash flows here. It is OIF, operations, investments, financing. So in operations, cash from daily business activities, sales, purchases, expenses. Investments, I have surplus money, what do? I keep it in shares, I keep it in real estate, correct? I can put it in mutual funds, it can be anything. So investments are there. So that is outflow. What is inflow? When I sell it, I get sale consideration. That can be cash inflow from investments. Financing, I need money into the business. From where do I get it? Either I get through my capital or I get through my loans or credit terms. What do you mean by credit terms? You purchase your stock or you purchase your asset and you tell him, boss, you give it to me, I'll pay you in 45 days. I'll pay you in 60 days. So actually for a period of 45 to 60 days, what is he actually doing? He's funding your business as such. So that is where the effect of credit terms also is important in cash flow statement as such. Now, I've given you a perspective of the entire the cash thing, why it is important, cash burn, how do you present it to say, how do you see it from investors' angle, how do we price the product, how do we do budgeting on an overall basis. Now let us try to understand what you should not be doing. For what you should not be doing, you need to understand top waste startups waste money. This is what we should not do. We have to be very careful. I've come across a very, very prominent, app, and each of you might have used all these days, day in and day out, to move your goods from one place to another, items from one place to another, wherein the promoter was not checking what kind of expenditure these people are incurring in the office. So it is very visibly, it is there that a fruit salad cup, which otherwise outside you're getting at say 25 to 30 rupees, they were paying 125 rupees. So the first day they gave that fruit salad bowl to me, I started saying, is there something called a golden lining around it because of which the price of this fruit salad is high? So, I mean, looks like very silly point, but I'm saying if you have 100 people and assume 100 into this 100 rupees, 10,000 rupees, you have already spent it on a daily basis and it goes on for 25 days, 2,50,000 without knowing anything, we have lost it. And at the end of the year, we have spent only on fruit salad 30 lakh rupees more than what it could have cost. That is the reason startups fail to understand, okay, they feel that the money has come from an investor, let me start splurging. That should not be the case. We have to be very mean here. We have to go with a lot of sense to ensure that there would not be any misallocation of resources. We have to be very, very careful about it. So from that perspective, let us see some of the points here. See, even when founders, they delegate financial tasks to, say, bookkeepers, CFOs, they must remain actively involved in overseeing the company's financial health. So you should, be attentive. You should understand that the bookkeepers don't know the business. See, as a bookkeeper, you take me as an accountant, you give me vouchers, I'll punch. That's all. What do I know as to why you are spending it? Is it required at all for your business? Only founders can know that. So this can lead to errors or it can lead to misunderstanding in financial reports as such. Founders should regularly review these reports, the income statements, financials and all that. And they should ensure they understand their company's finances thoroughly. Failure in this, it can result in missed opportunities to correct financial mistakes before they escalate. Once the money is gone, it is gone forever. We don't have any chance to get it back. So staying engaged in financial matters by a promoter is essential to ensure to keep the business. It should be in a solid footing. Business should be in solid footing. If we don't have backing of the cash, big chances that it will fail. It is very important message. Not many, few of it, I've tried to cover here. Founders often make this mistake, of hiring employees from large companies like say Google, Facebook, and they give them large salaries to lure them into startup. They'll think that, okay, this guy was CFO of Google and he comes to my company and he will make it into one more Google. nothing will happen. See, finally, it is to do with business, customer, pricing, quality of product, customer delight, right? All these things. Only the finance guy or a very big guy coming into the company alone cannot make it. Of course, he is valuable, but to what extent you can risk that salaries is very important. So these hires usually, they expect infrastructure and support they had in large corporations. I need to have a cabin of 20 by 20. Only then I'll get my ideas. That won't work. That will become very difficult to handle. So this mismatch that is there between salary expectation and actual value that they can give us, it leads to wastage of the money as such. So this is where, as promoters, we have to be careful. Next is over-reliance on contractors. We are feeling that everything is outsourced. They'll take care. So I'll just sit. Okay, to some extent, 5%, 10%, that is agreeable. Not that, everything we give them and then when we just, sit happy. Many startups try to save money by using contractors, okay, instead of full-time employees. Because full-time employees there, you have to onboard him, employment letter, his gratuity, his leave encashment, PF, his tax compliances, big headache. Instead, take a contractor, outsource him. That is simpler. So they would do it. But while these may, seem like, it may be like cheaper option, but often sometimes it may backfire as such. So it is very important to see that kind of cash outflow can you estimate to incur in your business. Then you take the contractor. Otherwise, you have to be frugal. Some amount of the work you have to do it, although it is accounting, it does not matter in the initial phase because we have to conserve the cash as such. Marketing people will spend left, right, and center. Founders are drawn to the scale of platforms like, something like Facebook, Google for advertising because of potential to reach millions of users. But ad spending can quickly spiral out of control. It can just go out of control. It can just be enormous. So initially, it might seem like ads are working, it is generating growth. But as the company becomes dependent on, say, paid advertising, costs can really escalate. Then what you're doing is to escalate revenue, you're incurring advertising. Escalating revenue, escalating advertising. But initially, the balance would not be there because increasing revenue is very small, but increase in costs will be substantial. So that is where we have to be careful. So it is easy to keep increasing ad budget as a quick fix for the growth. But this approach is not sustainable. Companies, many times they realize it quite too late by the time their cash. So ineffective marketing spend, we have to be very careful. This has become a fancy. I have a product, I have a service. Immediately first thought is, okay, let me go attend an event and let me do this sponsorship thing. So, sponsorship would not be, again, cheap. There are lakhs of rupees that they are charged. So founders are often tempted to go to these events and sponsorships as such. But these tactics are typically more effective for companies that already have product market fit. That is, you have a product, the market for your product, and you are timely. You are not early to the market or you are not late to the market, correct? So in those cases, your revenue is proportional to the ads that you're spending or the events that you're attending. Then there is no problem that you go into this. Startups that invest in, say, expensive events early on often fail to see that return on their investment. Instead, founders should approach events with creativity and frugality, finding ways to make it a significant impact without spending large amounts of money. So it can be through, say, some clever marketing tactics that stand out without breaking the bank. It is something like, I heard there is one business, this MBA guy who left MBA and then he started a tea stall, the MBA chai wala. He made probably a smallest of the design board on this one, and it just clicked. Such a smart marketing move. He need not incur any marketing cost at all. That is how simple it is. So what is it that we have to keep in mind? Discipline. Discipline is everything. This is one thing people would not be happy about because discipline is not entertaining. Okay, it is not like, what do I say? What do you people like? You people like, say, Formula One race, extravagant. Every time you like watching it, right? Life does not work like that. When it comes to discipline, it is very boring. Mind you, I'll tell you, it is very boring. But the point is, unless there is discipline, everything is a washout as such. That is what a startup entrepreneur should be very careful about. Every morning he gets up, he has to have his checkbox telling that these are the things I must be aligned to on a daily basis. Only then, the business can be stable. Otherwise, it will be roller coaster ride only. That is how it is. Okay. Now that we have seen several, things about the financial aspects of the startups, now let us see some of the terms that we are using in the startup space as such. What are these terms and why are these required? Let us straight away start on this. Gross profit and gross margin. What does it do? It measures profit before operating expenses by deducting the cost of goods sold from the revenue. That is sales minus what is the cost of that making that product. That is the gross profit. Why is it required? The quantum of the gross profit can show you, okay, so much gross profit I have, so I can now incur the money for salaries, rent, electricity, entertainment, repairs, vehicle maintenance, etc. So gross profit is the sale is not sufficient to meet all these expenses. You need gross profit, that is sale minus cost of your product. That surplus will allow you to incur rest of the expenses. That is why gross profit and margin are very important. Net profit is profit after deducting all the expenses. Simple definition. Then you have EBITDA. What is this? Earnings before interest, tax, depreciation, and amortization. What does it mean? It means what is my cash profit as such. Cash profit, but of course, before any of outside expenses, EBITDA means normally a pure business expenditure. Rest of it is funding expenses, asset usage expenses, taxes to the government. Those are not my business expenses, but these are mandatorily to be paid. So EBITDA clearly tells out of my business, how much money did I make? Operating profit. Valuation. The process of determining a company's worth, factoring in revenue, growth, intangibles. And you will start seeing this jargons everywhere. Pre-money valuation, post-money valuation. So what is it? The value of a company before a new round of investment, the value of a company after a new round of investment. What is the big deal in this? Right now, the value of my company is 1 lakh. I have 10,000 shares, right? I get 1 lakh as additional capital, okay? But because my company is already doing well, they'll tell, okay, we will pay you at 15 rupees. So they give 1 lakh 50. So what is the total capital now? 1 lakh plus 1 lakh 50, 2 lakh 50. But my shares has become 10,000 plus 10,000, that is 20,000. So it is 2 lakh 50,000 divided by 20,000. So obviously it is more than the 10 rupees right now. Correct? So that is called pre-money valuation, post-money valuation. Prior to money coming in, what is my value? Post-money coming in, what is my value as such? Then there is a jargon called convertible notes. So it is a kind of a short-term debt only, but with an agreement that, okay, give it to me as a short-term convertible note now. I'll tell the investor and tell him after some time, I'll give it to you as a equity. I'll give it to you as a share, something like that. Next comes customer acquisition cost. It is CAC. The cost to acquire a new customer, it is calculated by dividing marketing ad expenses by number of new customers. So how much did I spend to get one customer in the last month? How much did I incur marketing advertising per customer in the last quarter? How much did I incur CAC for past 1 year? Right? Does it make sense? Then you will start understanding, okay, this is the cost I'm incurring to get my customer. Is it the end of it? No. Once I get the customer, I should have lifetime value of that customer. What is the lifetime value? I have spent 1,000 rupees from this customer, for this customer to acquire him, the total revenue a company expects to generate from a customer during his lifetime. The customer during his lifetime, he is prepared to pay me 2,500 rupees. So, as long my lifetime value is more than CSA, I'm positive. Although the company right now is making losses, it can be a good formula to the investor to think that, okay, in the long run, this company is not going to make profit. That is the reason they do calculation of customer acquisition cost and what is lifetime value of the customer to that business. Then comes GMV, gross merchandise volume, the total sales volume in a specified period, often used in e-commerce business. So you need to just understand this. Burn rate, we have already seen. Cap table is called capitalization table. What does it have? Only 3 columns. Number of name of the shareholder, number of shares he has, what is the percentage? That is called the cap table. Simple. Retention rate, a metric indicating how effectively a company retains its customers, directly impacting revenue as such. Term sheet, a non-binding agreement outlining the basic terms of an investment such as valuation and funding details. In all these things, I have to say term sheet is something that is very important because as a startup entrepreneur, when you go for getting the money as loan or capital from your investor, they will tell, okay, let us enter into a term sheet. It is still not an agreement, but these are the terms of the investment. So that is called term sheet. Once this term sheet is entered into, investor sends his auditors to do due diligence in your company. The auditor gives a report telling that whether it is fit to invest in this company or not. Or a legal team can come and do legal due diligence and tell what is the ethics of this company, how much compliant are they, can you invest in this or not. So term sheet, due diligence, then based on due diligence report, investor will invest in the company or decides not to invest in the company. That is why the term sheet, I should say the threshold is very important to keep in mind. ESOP, employee stock option plan, promoter tells, see, all that thing is gone now, telling that, okay, I am running a business, all profits belong to me. Nobody will work with us. Things have become quite challenging, competitive. We need a lot of people to do the business and employees are important part for that. So unless we give one portion of the profits of the company and value of the companies to them, they would not do the work. For example, if you say a large company like NVIDIA, correct? All of you know NVIDIA, very large company, very innovative AI company. And you can see the amount of stock options they would have given to the employees because they want to retain the employees so that their product can grow. There is sustenance of the company for a larger time period of time. But advantage for employee is he is becoming almost like a partner in the company. It may be 0.1%, 0.5%, 1.1%, it's fine. But only thing is, apart from just being employee, now he's getting a share in the company as such. That is ESOP. Acqui-hire, the acquisition of a company mainly for its talent, not its products or services. So it's something like there is a company A, it is your competitor, you have enough value. Now you feel that, okay, that talent in that company is very nice. I want to take them. Nobody wants to leave. What do? You make an offer, take the company itself to you. So the purpose is to take 100 people from there. There was no other possibility but to buy the company. That is called an acqui-hire. Exclusive agreements. Legal agreements where one party provides products or services exclusively to another, often tied to financial deals. Why this is required is, in exclusive agreements, the other party tells you, okay, I'll give you 50% or 75% of your total production. This much time period, you have to produce and give it to me only. That is why it is exclusive agreements as such. So these are some of the terms that we must be aware as such. So those were all finance, few non-finance, some generic one we will see. Business models, B2B, B2C, D2C. All of you are very smart. You will already know about it, and on the face of the PPT itself, it is quite clear. Bootstrapping, starting a business using personal savings or money from friends and family. That is bootstrapping. So you will keep listening to many of the business leaders. They'll tell, I started my business, we just bootstrapped. So what is that? He borrowed from his uncle, aunt, parents, friends, and all that, and he started. Crowdfunding, raising small amounts of capital from large number of people. And I mean, the concept is already running because you have even movies that is made from crowdfunding. White labeling, a product made by one company is rebranded and sold by another. So in white labeling, we would not put the brand of our company. There is a huge customer that has come to us and he tells, I can sell more product of yours provided you allow me to put my brand on your product. So he will tell, you are selling only 1,000, you give it to me, I'm able to sell 1 lakh. So when you are happy, telling that, okay, to a period of say 3 years, I'll white label it, you put your brand on that, something like that. So changing direction of a business or product strategy in response to market conditions is called the pivot as such. Intellectual property, very important concept. See, these are each of the topics that I am just introducing to you right now is a topic. Depending on the topic, it is worth spending 1 hour to 2 hours on each topic, or probably half day in some of the topics. In some of the topics are, it's like a 1 day kind of topic. I'm just introducing everything to you. It may sound very fast, but it is better in the speed you try to understand everything that is possible. So intellectual property is the right on the product that you have. So unless you give that right to somebody, nobody can use your inventions, designs, patents, trademarks, and copyrights. Beta version, a pre-release version of a product used for testing before the official launch. First mover advantage, the competitive advantage gained by being the first to enter into a market. So anybody who has come into that specific market the first time, we always keep referring to the term, he is doing well, he is in this position because he had first mover advantage. So investors also may see that. SaaS, software as a service, a subscription-based model where software is provided over the cloud, accessible via the internet. Normally, when we buy any tech products, it is possible you get a link, you click on that, download it and get it installed. That is option 1. Option 2, don't do anything, just enter into a portal, put user ID and password. The subscription opens and the software opens and you can just start working on it. That is called SaaS. OEM is original equipment manufacturer. SKU is stock keeping unit. What is it? Liquids in liters, clothes in numbers, eatables or some rice or something like that in kgs, correct? Few in colors, few based on price. So we can have separate SKUs based on what is easy for us to track the products. So it is a barcode used to track products in inventory containing details such as size, color, and price. Conversion funnel, a process that tracks how potential customers move from awareness to making a purchase. So investors would ask you, what is your conversion funnel? So you have to tell, okay, I've done this kind of ad, so many people have given response. Out of this, okay, 25% have done. So 75% are in the funnel. They're in the conversion funnel. I'm about to turn them to potential customers as such. So I think I have spoken too much probably. So I would break here and thank you for this.
Thank you so much for such an intense session. I would say it has been really, really super informative, and the journey you have taken us through has been very, very valuable for students. We have a couple of questions. Okay, Shiva, please go ahead.
Yes, I will make it quick because you have other meeting. So I will explain my idea in short. So basically, we are building an edtech solution. So it's like a AI tool which can teach the students better by making it more personalized, like up to the point where the app evolves according to the user every day, based on your preferences, based on your strengths, based on your learning knowledge level, etc. So to make a product go live, we will need some investment. So, but we don't think we have enough funds to bootstrap our product, or like we don't want to lose a lot of equity during a pre-sales investment round. So what do you suggest, sir? So together,
have you exhausted all the bootstrapping cash that you were supposed to get? Is that finished, or are you left with anything?
The
personal savings can help you in and around. Is that exhausted?
No, sir.
I think that is one thing that you have to go first, pitch your product to them and try to understand what is their comfort, right? So always the product that we make, we feel that it has arrived and it is possible and it'll run. But the only thing is, yes, you have to put it to test. And unless you put it to test, there is no proof of concept. right? And you have to get that investor confidence telling that, yes, this is a good idea, it is going to make it. So probably you may have to do certain amount of demo to certain class of people and certain students, try to get the feedback and get those feedbacks, record them, document them, then go and take it to the investors, right? You will get some traction there. But before that, you have to see in which model you're going to run your business. If you have already formed a company, at least for companies, there are chances that some amount of funding may come from the banks as such. And if it is innovative, you have to immediately register under DPIIT. Okay. Under DPIIT, if you register, you get a startup recognition. If you get a startup recognition, there are chances that you may get the funding from the government also. So some 50 lakhs can be earmarked per startup. Don't know, it is a chance, it is a luck. I completely agree. See, in the recent budget also, they have kept aside 1,000 crores for startups. Now, the point is, how successful are we to get is the force in which we can put across the product to others. So you have to go, the first thing is proof of concept. Ensure that people like your product and you are able to get some good feedback. Take that with you as a documentation so that people are confident to give you money.
Okay, sir.
Drashti, you can go ahead.
Yeah, sure, ma'am. Hello, sir. And now
Hi.
everything in the market is available in plastic and microplastic, which is very harmful. So our startup is beyond on the coconut shell by using the waste coconut shell, which are totally thrown away. We make something that is also biodegradable, even if we have the product ready to sell. So how can I effectively identify and reach my target customers, and any specific certification or standard that I should aim to enhance my brand?
See, initially what I should say is, again, coming to the new product, the first step that we have to see is the product market fit. Right now, there have been several products similar to this that has already come, and many are still not profitable. Now, the point is, that is not the point. I'm not trying to discourage or do anything like that. The point is, can you make the product market fit? Unless the product is market fit, it is not going to sell. That is important. So in order to do it, again, proof of concept, same thing, what I told earlier, I would like to repeat. You have to get the feedbacks, make a documentation of that, okay? Then something is possible. And of course, if anything is to do with usage of the product, normally there'll be a lot of ISO and all those things that would come, but at this level, it is not possible to be done because that is an additional investment as well. So all that is not required for a startup at all. First, go to startup.gov.in. Enroll as a startup in that. There are several startup mentors at each stage as to what decisions that you are supposed to take right. Take help of those mentors. At product level, government has put several mentors on space. So startup.gov.in. This is a startup portal that all of you have to register. Initially, you will register. Later, you will go for DPIIT registration. Once you get registration, you will get a lot of benefits if you are in the portal registration as such. So each product wise, it will change. So specific to the product, I may not be able to tell here, but I can tell you where to go. Go to startup.gov.in. You will certainly find some solutions.
Okay, thank you, sir.
Thank you, sir. So with that, I think we'll go to the last point, which I would like to ask. So many of our students want to know what kind of tools we can use to manage, all these cash flow or any other tools that you would prescribe for them to use in an early stage to maintain all of these cash flow statements or all of that, which might be available.
See, the main thing is the promoters would not know accounting concept. So if you tell debit expense and debit asset, everybody will get confused telling that expense is something that is going out, asset is going to remain with me, why I have to debit both? Logical, right? But actually it is like that. So it is silly. But unfortunately, without an accountant, you will not be able to do it. So tool would be basic thing on a daily basis. Ensure anything that you incur, ensure to use credit cards. Don't use cash or use the UPI so that there is a free capturing of the data. Later, we can just download it to Excel and we can categorize the information in Excel itself. So once the basic information is ready, probably on a monthly basis, you can ask services of one of the accountant and tell him you just put it in Tally software and give it to me. That is very, I should say these softwares are very less expensive. So instead of you buying it, you tell them you use your Tally and give it. Give yourself a time of say 1 year or something like that. And every time he does the Tally, you tell him on a monthly basis, give me the backup also. So that in case you end the contract, you have the Tally backup with you, right? And once he does that, you will be able to, even in educational version of Tally, you can see balance sheet, profit and loss account and cash flows. This is most easiest option that you can find. Later, once your business scales up, I would suggest something like Zoho Books, which are very smart pages right now. And there would be several online, providers of services as well that also can be used by.
Thank you so much. Thank you so much for spending your valuable Sunday morning with us and giving us so much of insights for all of our students. It's been a pleasure, and it's very, very grateful for your smiley and energetic presentation. We really, really enjoyed it. And I think the students have enjoyed it as well. We will let you to the rest of your Sunday and definitely look forward to reaching out to you for further discussions and collaborations. Thank you so much, sir. Thank you so much.
Jessica.
Thank you, sir. Yeah.
Thanks, everyone. Thank you.